Hi again. Okay, Dave Stanfield with Evergreen Wealth Management, LLC. Just wanted to take a few minutes and talk about a topic that we talk about from time to time with financial planning conversations around life insurance. So I want to cover, do I have a need? Is there a need for life insurance? The different types, a little bit of the different types of life insurance, and also something that I see come up with people that are early in retirement in their 60s and sometimes early 70s. So first, do I need life insurance? A lot of people ask, and that's really the question. Do I need it? Do I have a need? Meaning, if something were to happen to me, what would the situation be for my spouse? Do I have young children? Do I have a large mortgage? What would the person be? What sort of financial situation or repercussions would there be if I wasn't insured? And then it's really just about working on, okay, let's say we do identify, and there's all kinds of ways to come up with the need. There's different calculators. There's a financial planning process. But let's assume that there is a need. Now that you know that you needed life insurance, what's a suitable product? And generally, there's two types out there. There's term insurance and then permanent insurance. Term insurance is more, I've heard renting. Permanent insurance is more of an ownership type of a product, something that's designed to last for the rest of your life. Within term insurance, and also, part of the deciding factor in which one you choose is going to be budget. Typically, term insurance products, the shorter the term and the younger you are, the less expensive they are. And if you're a little bit older, more of a risk, from an actuarial standpoint, then it's going to be more expensive. So let's go through, a couple different examples, and I also want to cover a pitfall, like I had mentioned. So, on this graph here, standard graph, we have your age down here. So let's say, you're 30 years old. And out here, 100. Okay? So let's assume that we're, signing up for, $500,000 of life insurance. And let's assume this is term life insurance. So, I haven't quoted this. You want to go out, and this, by the way, is in no means a recommendation, but yeah, you want to go out and shop for this. But let's say that, there's different terms. There's a 1-year term, a 10-year term, a 20-year term. Let's say we choose a 20-year term product. So, start here at 30 years, and out here you're 50 years old. Then the insurance company is going to say, okay, what's the risk for a 30-year-old, let's use a male in this example, passing away unexpectedly between age 30 and 50. And they're going to come up with a dollar amount for the premium. Let's say it's, $60 a month for life insurance. So they're going to cover you for that period of time, and maybe by that time, your kids are out of the house, your mortgage is a little bit smaller, and you have less of a need. At that point, the insurance would go away, and then if you wanted life insurance, at age 51, let's say you want the same product and wanted to cover for another 20 years from 51 to in your early 70s, it's going to be a lot higher than this, right? Because now, the chances are much greater that something may happen to you, and so the risk goes up, the cost goes up. So, typically I see a lot of 20-year, even 30-year term policies. You can get a lot. You're covered for a short period of time. But let's say that you decided that, I don't want to cover myself for a shorter period of time. I really want something where I can just pay into it. I'm okay paying a higher dollar amount, but then I want to be able to stop paying on it at some point in my life, and then just have that continue on forever. So that's more of a permanent policy, and there's different kinds out there. So let's just go through an example of what I see for an average 65 or 70-year-old that come into my office, and then maybe they started way back here when they were 30, right? But and they also got $500,000 of coverage, but the way that the insurance cost works is it's a 1-year term. So every year, let's say that the premium was $300 a month that they were paying for that policy. But in this case, out of that $300, when you're first starting out, maybe only, say, $30 a month is being subtracted from that $300 for the cost of actual insuring just in that 1 year, age 31. But then, as you get older, every year, the cost of that insurance goes up. As your age goes up, the risk goes up. And the idea is that the difference, in this first year, the $270, and then so on, all this cash, the difference between what you're paying out of pocket monthly and the cost of insurance, that money goes into a separate account and hopefully earns a higher return on some variable-based type of investment. And then, when you get out here, there's enough cash put aside in this product that the premium will stay the same. And even though the cost of insurance is going up, there's enough money in there, in this bucket, to be able to carry you on, for life. But what I see, fairly regularly is that this really didn't work out the way they had intended. Maybe the market had, gone down. Maybe there was excessive fees, but they have a much smaller part of this cash. So this insurance cost, keeps going up. Let's say that, here they have, if you look at their monthly statement, it shows how much cash, what the cash value of their policy is. Maybe it's only $10,000 of cash when they were thinking it might have been $50,000 or $100,000. Then at some point, what's going to happen is it's going to be more than $300 a month to sustain that policy because the cost of insurance is going to keep rising. So at a certain point, if that person doesn't put more money into the policy to keep it afloat, then the policy will lapse. They won't have the premiums. So what you really have to do is one popular thing is to contact the insurance company and then ask them to run what's called run an in-force illustration, just to try and play out, okay, now that I've had this policy for 20 years, based on the cash that's in there and what I'm paying now, is it going to make it to if I live to age 100? And they'll be able to tell you, okay, really, there's only 5 years of cash left or 10 years of cash, or you know what? Yeah, there's plenty of cash. There's also certain options that you have. Sometimes you can reduce the 500,000 to maybe 100,000 if the policy is designed that way, so the cost would go down. Or maybe you've decided that now that you're 60 or 70, you don't remember the need conversation. You just don't have a need for that product. So maybe it's okay that you just part ways with the insurance company and stop at that point. So anyway, just wanted to cover a few different points on, do you need life insurance? What are the different kinds? And then some things that I see later in life with different types of products. Happy to help you do an insurance review. Contact me to talk about anything else. You have my contact information. Look forward to hearing from you. Thank you very much.